and welcome to the Global View on this Monday. Let's get into it just as far as what we're seeing at a macro level, and begin with US jobs growth. Accelerated more than expected in November, with non-farm payrolls increasing by just short of 200,000 jobs. And in a further sign of underlying labour market strength, the unemployment rate fell from 3.9 to 3.7%, alleviating some concerns that the US economy is in danger of tipping into recession. The US 10-year yield, they rose about 12 basis points to 4.24%, while the 2-year jumped 15 basis points to 4.72% after that jobs data. And the next key point of data for the Fed to consider CPI figures this week, ahead of the Fed's decision on interest rates, with it expected to keep rates unchanged. All financial markets have now lowered their bets for a rate cut in March, with traders pricing in a 46% chance of a 25 basis point interest rate cut for March. That's down from 65% just a day earlier. And hopes of a rate cut were supported by the University of Michigan survey, which showed consumers' 12-month inflation expectations plunged to 3.1% in December. That is the lowest reading since March 2021. And the US dollar index gained off the back of a stronger than expected jobs data. The Aussie dollar currently trading at 65.8 US cents. Now, in international news, the EU has reached a provisional landmark deal governing the use of artificial intelligence, including government's use of AI in biometric surveillance and how to regulate systems such as ChatGPT. And in company news, health insurer Cigna has pulled the pin on its takeover pursuit of rival Humana, which would have created a more than $140 billion company after the pair failed to agree on a price. Cigna now planning to buy back $10 billion worth of shares. Elsewhere, chipmaker Broadcom out with a trading update, tipping full-year revenue to come in below forecasts as weak enterprise spending and stiff competition act as a shadow on its takeover of rival VMware. And global miner Anglo American will trim capex by nearly $2 billion by 2026 as it grapples with a fall in demand for most of the metals and mines and a write-down of its British fertiliser project. All right, well, big news last week, of course, Woodside and Santos having begun preliminary merger talks. So what are the pros and cons? Which shareholders bear greater execution risks? Todd Warren from Tribeca Investment Partners joining us now. Todd, good to see you.
Thanks, Andrew, for having me.
All right, well, did this come as a surprise? Because obviously Santos has been struggling. You take a look at the share price there. And given, I guess, what we're seeing more locally in this energy market at the moment, what's your view?
It was a surprise in some sense that the talks were actually underway. There'd been obviously some chatter around Santos as a potential target in the preceding few months. We've had some shareholders start to agitate for some sort of strategic review. But I think perhaps Woodside was not maybe seen as the likely acquirer. So it certainly did come a little bit out of left field.
Okay, let's assume then that it goes through and you get agreement for both sides then. What would this create, a merger of the two? A very globally significant independent oil and gas producer. I mean, it would actually put them inside the top 10, close to top 5 of global oil and gas producers. Certainly outside the super majors. Very dominant producer of LNG globally. I mean, the combined entity would have about half of its production of LNG into the global markets. And you'd argue a pretty attractive proposition from a free cash and dividend potential company with the ability to fund some interesting growth projects. Well, how do you think the shareholders in both companies are going to react, particularly from the Santos side, do you think?
Yeah, well, that's the key question, right?
Yeah.
And we've seen obviously a bit of a pickup in the Santos share price, and that will be the key for essentially Woodside putting enough on the table to justify Santos shareholders taking on Woodside scrip. There is obviously a decent sized discount in Santos versus global peers, and indeed Woodside. So it would take a bit of convincing, I think, of Santos shareholders. There is the prospect that the Santos shareholders have obviously been through the pain to this point. It has underperformed over the last couple of years, really. And you have the reality that in its share price today, some of the negative headlines around the Barossa project, which has been pretty well talked about, are already priced in and more. So at this point, you need to be convinced that as a Santos shareholder, you're taking on the risk that Woodside don't go through the same thing with Scarborough. and you're left with the same sort of headwinds. Whereas you could argue that you're sort of through the worst of the news flow with Santos and perhaps looking at the prospect of more upside. So that's the challenge. I don't think we've seen anywhere near the sort of upside yet with regards to the Santos share price to really get shareholders on side just yet.
What are the possible regulatory obstacles that face?
Oh, look, definitely here in Australia on the gas side, both Western Australia with regards to the domestic gas reservation there in Western Australia, both Santos and obviously Woodside with their LNG projects in Western Australia, but on the East Coast as well. You have Santos with their GLNG project in Queensland, and also Woodside with their Victorian assets they picked up from BHP, of course. So you've got both sides of the nation, and it would definitely require some degree of asset sell down to get the competition authorities on side.
Is consolidation in the local energy market inevitable?
You'd argue yes. Well, I think if you think about what the combined entity would be, it would really create an entity you'd find it very hard to go past.
Yep.
From a sheer size perspective. Then, it very much becomes, daylight second, and you very quickly come down the size spectrum. But at the end of the day, there are a number of smaller Australian companies struggling for scale, and we probably should see a continuation of M&A even at the smaller end of the spectrum as well.
Todd, what's your view more broadly on energy markets at the moment? Obviously, we've seen oil come under considerable pressure.
Yep.
That is on concerns about the outlook for demand next year.
Yep.
OPEC Plus intervention underwhelmed the market. What's your outlook?
Yeah, it did underwhelm. I think the underwhelming nature of the market response was probably more related to concerns around the other members of OPEC actually sticking to their commitments. We've seen the Saudis seemingly being reasonably strong on their commitments. Obviously, they've committed to 1 million barrels out, and this was sort of the next leg of the stool, so to speak. And there are obviously some concerns there that compliance with those quotas will be met. Longer term, we've seen, as you say, seen some demand concerns roll through the market. We would argue that at this point, oil again is sort of looking at or feeling like a no friends market. The equities have sold off. Santos and Woodside as examples in this market, but other names in the Australian market like Karoon have seen a very big pullback. And we've tended to find that from $70 there tends to be a bid return to the market. There's concerns if oil goes to 100 that it starts to impact on inflation again, but we would be more of a buyer than a seller at $70 oil.
All right. What about on the gas side of the equation with LNG prices? Fairly subdued start to the Northern Hemisphere winter.
Yeah. Look, there's definitely a seasonality trade to it, whether it's LNG or the other parts of the energy spectrum like thermal coal. At this point, obviously there is a hope, I would say more than anything, that the Europeans at least have got their house in order with regards to storage, and certainly storage levels are at high levels certainly versus the average. We need to have a moderate winter for that to remain the case. The reality is that the Europeans still have a ways to go with regards to building out their insulation outside of Russian supply. They are in the process of building more LNG regas facilities, but it is, as I say, reliant on the reality being a moderate winter. If we get a cold winter or it turns cold, gas will get a bid.
So while I've got you here, love to get your view on iron ore, a bit out of your remit, but given, I guess, what we're seeing in China at the moment, certainly analysts have been very surprised that the iron ore prices maintained those levels. We're at, 135 US a tonne at the moment. Yep. Is that sustainable?
It's certainly been higher than most market participants have expected. Both corporates and investors and sell-side analysts, I think, have all been undercooking the price. What is the landscape going forward? I think we will see more and more focus on quality. We've seen the spreads for both the premium grade iron ore come in, and we've seen the discounts for lower grade iron ore come in. We would expect that to widen again, and increasing focus on higher quality, higher grade iron ore we expect that premium to go up. certainly as the ongoing focus on moving towards a green steel product or greener steel product. That will certainly play towards the producers of high grade and away from the lower grade production. Obviously, there's a seasonality component to it. You want to be typically buying or owning at least iron ore into Chinese New Year.
Certainly a focus on green steel, certainly as far as Fortescue is concerned. How are the three big players, Fortescue, Rio and BHP, placed at the moment, do you think? I guess particularly with BHP's diversification.
Yeah, well, I mean, BHP talks more about the diversification, but the reality is both BHP and Rio actually have a pretty similar makeup to their portfolio today with regards to the amount of earnings generated by iron ore. It's still 2/3 to 3/4. Fortescue, of course, is more of the pure play, albeit with more of a green angle to their future earnings. BHP delivers a slightly higher quality product, so is not as exposed to discounts. Fortescue is more exposed to discounts. So coming back to my previous comment, that's where we would expect some challenges perhaps. And then the much smaller operator, or at least Australian listed, albeit with offshore assets, is Champion Iron, who does deliver a much higher grade product, albeit they're a much smaller player.
Todd, great to get your outlook and your analysis. Thanks for joining us from Tribeca Investment Partners.
Thanks for having me.
All right, that is the global view. Just a quick check. We're almost at the open, and that's where we're set to begin. SPI futures are up around 1/5%. Stay with us. Open just a minute away.